much confidence. Yeah, I know I grew up in the ghetto. Too much confidence. Bad bitch heading on a nigga. Yes, I'm alright. Sky fly high like a kite. No, too much confidence.
Hello everyone, welcome to another video of Forex Systems from a poor background. My name is Sibusiso Mtiniso, and today I'll be going deep into what technical analysis is. So in this video, I prepared for you a slide where I go deeper into what technical analysis is and also be discussing the tools that we're using in technical analysis. So without wasting any further time, let's jump into the slides. So today we'll be talking about what technical analysis is, and also I'll be describing the tools that we're going to use in technical analysis. But first, I'll start by giving you what the purpose of the tools are, and also go deep into what trend lines are, and also show you on a live market chart how do we see a trend line. And another thing that we're going to speak about is the support and resistance, and about candlestick patterns and chart patterns. So in these chart patterns, I'll also be giving you a beginner strategy, the strategy that you're going to use as a start for your trading journey. So let's go into the first point. What is technical analysis? So technical analysis is a trading discipline that traders use to identify trading opportunities by focusing on patterns of price movements. So as traders, we're looking at the markets before we can take a trade. So when we're looking at the market, the things that we look at is that we try to identify trading opportunities by looking at the patterns that the price is doing. So when we're looking at the market, we'll see what the market is doing and what kind of a pattern is doing, and then we will take that pattern and keep looking at that pattern each and every time we're looking at the market, and use that pattern as a way to enter our trades and also have our stop loss and our take profits. So the purpose of the tools in technical analysis is that they help us understand the market structure. So in the market, the only thing that helps us is the tools. So these tools, they can help us see the market structure. They can help us see where the pattern is. So basically, when you're looking at the market, you're not going to look at everything. You're just going to look at the pattern that you're looking for. So another thing is that it also helps you to find the area of value, because the most area of value when you are looking at the market is obviously your strategy. So these technical tools, they help us see where the pattern is located when we're looking at the chart. If you don't find that pattern in that chart, there's no need for you to stay to that chart. You need to move on to another chart up until you find the pattern that you're looking for. Another thing is that they also help us understand entry triggers. But don't worry guys about these 3 points, because I know that there's so much information about these 3 points. That is why there will be more videos in the upcoming weeks where I explain the market structure and also how to see your area of value and also understand the entry triggers. So let's move on to the next slide. So in this slide, we're going to talk about trend lines. So what is a trend line? A trend line is a line drawn over pivot highs or under pivot lows to show the prevailing direction of the price. So I know guys, this doesn't make sense, but I think it's best if I go to the chart and try to show you there on the live market chart. So looking here, we have our USD CAD. So I want to try to zoom it out a bit. Okay, so now let's see at this area right here. So if you can look at that area there, you can see that those two red lines is what we call trend lines. So these trend lines, they help us to understand in which direction was the market moving during this area there, in this triangular box. So in this rectangular box, so you can see that the market was going into the upside. So how do we see that? So we can see that with this line that we have drawn here, the market, every time we reach that line at the low, it created pivot lows, that is turning points to the lower part, pivot low, and then here it created pivot highs and pivot highs. So in an uptrend, pivot lows, we call them higher lows, higher low, and pivot highs, we call them higher highs. But don't worry guys, as I said again, if you subscribe and stay with me, I'll make sure that when I'm describing the market structure, I go deep into what the higher highs and higher lows are. basically I will go deep into uptrends, downtrends, and consolidation. That is the market structure of the market. So let's get back into our slides. So trend lines are a visual representation of support and resistance at any time frame. They show direction and speed of price and also describe patterns during periods of price contraction. We usually draw them to spot if the market is an uptrend or a downtrend. So at that live market chart that I've shown you there, we've seen that the area that I've shown you specifically had an uptrend because the market was going to the upside. So I hope you understood this, guys. So let's move on to the next part. Support and resistance. So this is the second tool, that is support and resistance, but we want to speak about resistance. So a resistance is when the market tend to move to the upside and then pulls back, leaving the highest price point possible. So this highest price point possible is what we call the resistance. So it indicates that the overall of traders around the world is no longer willing to buy, but now considering to sell on the market. So what do I mean by that? Again, I've also prepared a live market chart to help you understand this resistance. So let's open XAU USD. Let's work on it here. Okay, now we can see here, let's look at this area here, so as we can look here, we can see that there's something that is happening whenever the price is reaching this zone or this area. Yes, so if you can see, every time when the price is reaching this point, it's going to the downside. Every time when it reaches here, to the downside. When it reached here, it again went to the downside. So this is what we mean by resistance. So when the price was here, the price moved there and then created the highest possible price there, and then after it did that, it went to which direction? To the downside, leaving that area as a possible resistance. And then when it came back there, it confirmed it by shooting to the downside. You can see this, how big this candlestick is, meaning that the market, when it got there, it reversed, and then it came back, it went back to the upside again, and then it did the same thing there, and then it did what? It reversed. So basically, a resistance is a zone where the market is being resisted to go to the upside. So I hope you understood what resistance is. So now we can move on into the next slide. So let's pretend that the market now is moving to the downside and then it pulls back up, leaving the lowest price point possible. So that lowest price point possible is what we call the support. So this support indicates that the overall of traders around the world is no longer willing to sell, but now considering to buy on the market. So what do I mean about that? Let's go back into our live market chart. So again, looking at the same area here, looking at the same rectangular area, you can see here that whenever the price was dropping, it was resisted somehow by an area of the zone. So this is basically what was happening. Let me try and put another color so that you don't get distracted a bit. Okay, so we can see that every time the market was going to the downside, and then when it got here, it went to the upside, and then it came to the downside here, meaning that when it came to the downside, it realized that this price was the lowest possible price, and then what it did is that it respected that and then went to the upside. So this area was then confirmed as what? As our support. So what is a support? So a support is an area where a price can go to a downside but cannot never be able to break below that area. Hope you understand this, guys. So we can go back to our slides. So how do we trade this support and resistance? So there's basically two ways that you can do to trade this support and resistance, and these are the most basic ways that traders do. So the first way is that they can trade reversals, or sometimes they call it the bounce. So what this means is that you can buy when the price falls to the support, or you can sell when the price rises to the resistance. So another way is that you can trade the continuation or the break. So what this means is that you can buy when the price breaks through the resistance, or you can sell when the price breaks through the support. So how do we know if now the price is going to bounce or break? As I've said it already, guys, you shouldn't worry. If you stay with me and make sure that you subscribe, there will be videos later where I show you guys how do we actually spot if the price is about to break or the price is about to bounce. So let's move on to the next slide. So now we're gonna speak a bit about candlestick patterns. So what are candlesticks first of all? So candlesticks are a visual representation of what is going on in the market. So by looking at them, we can get a valuable information about the open, the high, the low, and the close of the price. In candlesticks, we have what you call the bullish candlestick and what we call a bearish candlesticks. Notice that on a bullish candlestick, the open is low and the close is high, and then in a bearish candlestick the open is at the top and the close is at the bottom. So looking at the picture there, you can see that in our picture we have this green candlestick and this red candlestick. So this green candlestick is what we call the bullish candlestick. How do we see it? Because you can see the open that I've talked about is at the low and the close is above the open, and then here this is a bearish candlestick because the open is at the top and then the close is below. So this green and this red is what we call real bodies, and then these lines here is what we call shadows, or others they can call them wicks. So at the low we call it the lower shadow, then at the high we call it an upper shadow. And then also again at the top here, this is our high, this is our low. So let's move on to the next slide. So candlestick patterns are the most powerful trading concepts. They are simple, easy to spot, and you can become a consistent profitable trader using their setups. Understanding how to read them the right way, that is by understanding the psychology behind them, can put you in the right path in your trading career. So right now, I want you to focus on the anatomy of the pattern, because this will help you get that. So right now, I want you guys to focus on the anatomy of the patterns, because this is going to help you get the skill to identify them. So you will learn the psychology behind each pattern and what it tells you to do next. So now the first candlestick pattern is what we call a doji. So a doji, this is when the market opens and closes at the same price. So this indicates that the market is likely to reverse. We have three kinds of dojis. The first one we call the neutral doji or the long-legged doji. So this type of a doji is when the upper shadow and the lower shadow are equal in length. The second doji is called the gravestone doji. So this is when the upper shadow is lower than the lower shadow. We can see here in the image here. So this one creates selling opportunities. So it means that now we can see that the force is to the downside. It means now the force is to the sellers. And the last one is the dragonfly doji. So this is when the lower shadow is longer than the upper shadow, and again this one creates buying opportunities, as you can see here. Second candlestick type is pin bar. So a pin bar, this candlestick is created when the open and close is roughly the same price. So unlike dragonfly and gravestone doji, this type of candlestick has a real body. So remember the dragonfly and the gravestone and the neutral doji, they didn't have any real body, but pin bars, they do have real bodies. So when this candlestick happens, it shows a rejection in the price movement. So we have two kinds of pin bar. The first one is the bullish pin bar, that is can be formed by what we call a hammer or an inverted shooting star. So what is a hammer? A hammer is this one here. If you can see this one here, this one has a real body that is green and this one has a real body that is red. So this creates buying opportunities. A bullish pin bar with a green body is stronger than the one with the red body. Moving on to the second part, a bearish pin bar, that is, it has the inverted hammer and shooting star. Again, this picture over here. So you can see this one, it's an inverted hammer because it has a green real body, and then this one is a shooting star because there's a red real body. So this is when the upper shadow is lower than the lower shadow, and then this creates what? Selling opportunities. A bearish pin bar with red body is stronger than the one with a green body. So right now we're going to talk about engulfing. So engulfing pattern is formed when the current candlestick fully engulfs the previous candle. This can be more than one previous candle. Even one candle fully consumed can be considered as an engulfing pattern. So it doesn't matter. So it doesn't matter how many candles it has engulfed. The minute it engulfs the one that is previously, then that's when you can confirm it as an engulfing candlestick. So we have two kinds of engulfing, the bullish engulfing. So this is when the first candle is a bearish candle, smaller than the second one, which is the bullish candlestick. So this creates buying opportunities. So the bearish engulfing is when the first candle is a bullish candle, smaller than the second one, which is the what? The bearish candle. So this one creates what? A selling opportunities. Here are some examples of the bullish candlestick, the bullish engulfing, and the bearish engulfing. So now we're going to speak about a morning star. So this is a bullish reversal pattern and it consists of the three candlesticks. So the first candlestick will be the bearish candlestick. You can see this one here in the picture here. So this is the bearish candlestick, and then the second one is going to be a small candlestick. Either it's going to be bullish or bearish, and then the third one is going to be a bullish candlestick, which is going to engulf the previous candlestick and the first candlestick, and then it's going to be above its half. So morning star creates what? Buying opportunities. Having the bullish candlestick on the second candle gives it more strength. So as you can see in this picture here, we have the bullish candlestick, which means that this morning star has more strength than the one which will have a red real body there. An evening star. Now this one is a bearish reversal pattern. It consists of what? Of three candlesticks. So the first one is going to be the bullish candlestick, and then the second one is going to be either going to be bearish or bullish, and then it's going to be smaller actually. And the third one is going to be a big one, bearish candlestick, which is going to engulf the second one and also engulfs up until above the half of the first candlestick. So this one creates what? Selling opportunities. So having a bearish candlestick on the second candle gives it more strength. So again, all the candlestick patterns, that's what you need to understand, can never be traded alone. That is why when I'm doing more videos, I'm giving you the purpose of the tools in technical analysis when I speak about the market structures and the areas of values and entry triggers. That's when I'll be giving you all the information so that you can understand that the candlestick patterns, they can never work alone. And then I'll go deeper in what we call factors of confluence, which are going to help you confirm your entries. So right now we're going to talk about the beginner strategy, that is the double top and the double bottom. So we're going to speak first about the double top. So what is the double top? The double top is when the market creates a shape of N and then gives you a candlestick confirmation of a reversal at a resistance, confirming that there's actually a resistance area there. So when that chart pattern is formed and then you see a candlestick pattern confirmation, something like a reversal pin bar or an even star. So this shows you that the market is very likely to move to the downside, completing a pattern like M. Let's look at this picture here before. You can see here from this section here, the market moved to the upside and came to the downside and moved to the upside, and then look at there what it did there. So here it created a reversal pin bar. So do you remember what reversal pin bar is? That's an inverted hammer. And then look what happened after. So what happened after is that it completed that as an evening star, which gave it more confirmation to go to the downside, creating an M formation. I hope you guys understand this. Don't worry, if you don't get it, I'll explain it more further in the public Telegram group. If you want to be the part of the Telegram group, make sure that you click on the link on the description below there so that you don't miss when I'm getting to the market, into the live market there, explaining deeper about how do we actually see this strategy. And basically there I'll also be guiding you when we're trading this strategy, meaning I'll also be helping you identify support and resistance and also be helping you trade those kinds of strategy. So let's move on to the next one. So the second one is basically the same thing, the double bottom. So it's like the N to W reversal buy. So this is when the market creates a shape of N, then gives you the candlestick confirmation of a reversal, confirming a support area. So when this chart pattern is formed, a reversal pin bar again or a morning star occurs, and it shows that the price is very likely to move in the upward direction, creating buying opportunities, which will complete a shape of like W. Let's look at the picture here. So before you can see that the market was going to the downside, and then it reached this point and it reversed and went to the upside, confirming this is a support area. Then it came back to the downside. Then look at what it did when it got here. So it started moving in slow direction. After that, it created a hammer. That is the reversal pin bar, created a hammer. And then what it did after, it moved to the upside. So I hope you understand this, guys. And again, I'm gonna go deeper into the Telegram public group there, and I'll also be guiding you in each and every step there. So make sure that you join the public Telegram group. Thank you so much, guys, for watching until this very end. If you have liked the video, make sure that you hit the like button, and if you have anything to say, make sure that you put that in the comment box. If you want to see more videos that I'll be uploading where I speak about the market structure, the area of values, and the entry triggers, make sure that you subscribe and hit the notification bell so that you can be notified when the next video comes. Thank you so much, guys, and have a good day. Cheers.